Let me tell you what I like to talk about. I'm a long-term strategist because I find last decades liquidity in the market is not great. It's not easy to make your money off tactical investing, given that in today's free information society, everybody knows everything and all the opportunities get hoovered away by the big industrialized arbitrage machines. So in addition, a lot of investors, particularly the ones I'm talking to, are now so large, they are tankers. They can't move in and out of markets. So I'd like to talk to you about is what do you own strategically? So my target horizon is 10 years, a bit longer than what I think business cycles will be like in the future. Hence, I don't have to deal with, are we in a recession or an expansion mode at that point? I'm looking at an average of all of those. So, and I'm trying to think about if I got $100 or euros or Swissy, what do I do with it? Under the assumption I can't move in and out. I am married with my portfolio. So that's a question of what kind of returns can I make in different markets? What kind of risks do I get? And I'm going to be showing to you, hopefully convincingly, it's not a good story. That a standard 60-40 equity bond portfolio in the US, I'm talking about 3%. In Europe, probably a two handle, 2% on that nominal. After tax and inflation, it's all gone. What can you do about it? If you indeed feel you want better than that? So do you simply have to move up on the bond equity risk trade-off line and go for the riskiest stuff out there? That's not a free lunch, because risk means that you can lose it all. Or are there other choices? Fortunately, I think there still are some assets that will probably give you a better return to risk. That is, they lie above the risk return trade-off line. And I'll mention a few of them, of those. So finally, the other section is the future going to be like the past? Can we simply look at the past, do all our data analysis and figure out, here's what the future is going to look like? Not exactly. I'm going to make an argument that there will be change that we should be expecting. There's a number of things we can address from that. There's climate. There's a whole question whether market capitalism is proven not to be the best thing for the world, and hence we are moving back. There's a rise of China. There's a whole post-COVID world. I'm going to be focusing more on the last one. Are we staying in a low yield environment, or are we moving out? And I think the odds are that we'll be moving out because of the arrival of inflation. So let's start with this. What type of returns can you make? On 10 years out, it turns out it's actually not that terribly hard. It's a lot harder to think 10 days out or 10 months out. In the fixed income world, in the upper left corner, I'm showing you on the vertical axis a 10-year rolling return on the US aggregate bond market. That's the combination of treasuries, mortgages, and high grade, the AG as we call it. And on the horizontal axis is the yield on that AG at the beginning of each 10-year period. And the dotted line is a 45-degree line. Obviously, this tells you the yield is your future return. Very little risk around that on 10-year compound returns. And that is because in bonds, you get a form of time diversification, I call it. If you see an environment where, say you are in an inflation environment, yields are steadily rising, you will have losses on your bond portfolio. Probably for a few years, there'll be negative returns. But these bonds ultimately mature. And if you have a standard bond portfolio, which typically 5, 6, 7 year duration, every year they're sliding down and they get replenished by new bonds that are issued at par at higher coupons. So ultimately, future income gains will be offsetting your earlier price losses, and pretty much, as long as we're talking about twice the duration of your portfolio, the two offset each other almost perfectly. The equity market is a lot harder. Written a whole paper about looking at many different signals that allow you to forecast what future returns you're going to be making on equities. This is on the US market. I put a table here with a variety of signals with the root mean square error of each of these signals on in a recursive manner on how it forecasts future returns on a 10-year compound basis, and then what implications it has for the next decade, which we started at the beginning of this year. You can use your CAPE, your cyclically adjusted signals. You can use the CAPE yield of the equity market minus your bond yield. You can look at dividend yields. You can look at the amount of equities that households have in their portfolios. You can look at an earnings yield plus inflation. We have a variety of signals. They're not very consistent. They're a bit all over the place. The best thing is when you have signals that are, none of them are really that superior, is that you use a combination of those. I'm getting about 4% of that. Our asset management group has the same number with an entirely different model. I've looked at the consensus of all the asset managers and the long-term strategic advisors in the US. We're coming up with about 5.75 there nominal. And I think I should probably discount this. Is probably a bit of marketing in that. So if I'm right with a 4 handle on equities, the current yield at the moment, last night we're at 144 on the US ag. So you combine those, I get about 3% return on the 60-40 portfolio. So there is a question. Here, just one chart to show you some of the problems that we're having with the equity market. Everybody's aware of. On the left side is the trailing multiple on operating earnings on the US equity market. We're quite high there. If you're doing it a bit forward looking, I'd say we're probably in the low 20s at the moment, assuming the current high profit margins will be maintained for the next few years. You see that multiples mean revert. So everybody who looks at the same chart says, I have to assume some form of mean reversion in multiples. That by itself, value is not necessarily a good forecasting model, because ultimately the investor doesn't really look so much at value. They try to assess future returns, and they have a starting point of how much they have. And that's where the problem is in the US, not in Europe, not in the rest of the world. In the US, households, and that is your right chart, have all-time high allocations to equities at the moment. Tom, there is a hope among many that low bond yields basically make the bond world uninvestable. Hence, everybody has to be in equities. This is a 4 chart for 4 different countries, including Switzerland in the lower left, where we put in blue the 10-year yields, in red the multiple. So the 10-year yield is on an inverse scale there to be comparable with the multiple. Conclusion from all of those, the red and the blue line are historically not correlated. Lower bond yields did not give you higher multiples there. So don't necessarily trust there is no alternative, and low bond yields are the reason why equity markets have to be high. Can this situation change? Before we talk about what to do and what to buy within your portfolio, Tom, the core of low bond yields and of low equity yields, reverse of multiples, is the secular move in the last few decades towards zero interest rates. I'm giving you the standard economics explanation that interest rates are a function of the supply and demand of capital, saving and investment. Savings have increased, investments have fallen, higher savings rate too long, higher people are living longer, massive inequality in the world where the rich save a lot, the poor don't, and the rich have all the money, massively high corporate profits, which means that corporates have become savers. On the borrowing side, the new industries online, on the internet, don't need a lot of capital. So the world of the private sector has become very capital light. We have overall weaker growth. Governments actually have not been until recently being big borrowers here. Volatility has fallen, which lowered risk premium, and we had low inflation. So your savings increased, your interest rates, your investment fell. That gave you a lower equilibrium of interest rates. All of that is now, can this change? I'm going to make an argument that yes, it is likely going to change because this world is largely driven by the movement towards free market, I call liberalization, globalization, and the great moderation, stability oriented macro and monetary and fiscal policy. All of that was meant to improve growth. You stabilize the macro side, you make you let the private sector loose, you get the government to pull back from controlling the economy. That was supposed to be all improving growth. That hasn't exactly happened. And here's how we have to think about I call it the principle of change. So one important thing to remember from this is that the world, our models, the way we behave is not completely stable and stationary. It is not random. It is very systematic. The world changes, our behavior changes because we learn. The principle of economics and finance is we take all relevant information into account and then we optimize our behavior, our decisions, our spending, our investing. And tomorrow will be different from today because tomorrow we learn what happened today. So accumulate information constantly. We learn, we re-optimize. So our behavior, the parameters that describe what we will do, how we spend and invest, constantly adapt. And we all do this, but not in a coordinated fashion. And the simplest way to think about the policymaker on one side looks at the world and says, aha, here's what we have to do with inflation, fiscal policy, and the like. And as a policymaker then changes their behavior towards what they think is optimal, the world looks at them and saying, aha, they have changed and they change their behavior. So this is how we never really have a completely stable world. So in particular, when something really happens that hurts us on the downside, we're more likely to change our behavior. So what have we learned? We have learned that this great moderation, liberalization, and globalization, which was supposed to create the end of history, a much better world, actually coincided with and may have caused much weaker growth, much worsening in inequality. It's permitted climate change because the government is supposed to be pulling back from intervening. And well, under its, now we have one of the biggest externalities in the world, which requires collective action. So the government's not being very active did not help with controlling and mitigating climate change. And we had a number of financial crises. The central banks learned that the Phillips curve, inflation versus unemployment, that trade-off actually, which they thought during the Freedman Revolution was vertical, that it basically, the unemployment rate is something that the government cannot really affect. It's a natural rate, and inflation is a function of monetary policy. So you might as well keep inflation very low. Now it turned out, basically the last 20 years been very flat. High unemployment, low unemployment has not affected inflation. And as a result, we might as well go massively for the lowest unemployment rate possible, get this economy red hot, because there is no inflation penalty anymore. And that is what the US is learning. And that's what Janet Yellen is saying. Go big, go for it. Hysteresis has been, it's an economics word that says economic volatility is not simply volatility. Recessions do long-term damage. The longer people are out of a job, the more they lose their skills. Hence, we got to do something to get people going faster. And we're learning in Europe and Japan and increasingly in the US that these zero rates are really becoming counterproductive. The more you push rates down, it's supposed to improve spending, but it turned out that people actually increasing savings because they need to maintain a certain income flow. So all of that is leading to a rethink of monetary and fiscal policy. I think the US is leading this. Europe is behind with this. The euro area is still constrained by the Maastricht Treaty. So the US is now, I think, not explicitly saying so, but it is moving towards a new policy regime on fiscal policy. The Larry Summers view, sorry, mistyped, the Jason Furman view is starting to dominate, which says that to GDP doesn't matter. Interest rate covers matters. And we have negative interest rates. So we have a global savings glut that the private sector is unable to use. Now is a moment for the government to grab all of this and use it positively for climate mitigation and adaptation and for the many social ills that are still prevailing in the US. So I think the US is going to go for bigger and bigger deficits from hundreds of billions to trillions until the market says no. And on inflation, when I grew up, a high number was a bad number. Now it basically is the opposite. And now we're saying, no, we don't like low inflation. In that we're going to go for higher inflation. So I think the US is going to keep monetary policy very easy, fiscal policy very easy. And as a result, we're probably going to see a new regime, more growth, actually, more growth volatility, higher inflation volatility. And as a result, shorter business cycles. I'm going to be reflecting my age and saying everything is happening a lot faster nowadays. So the issue is, what does that world look like? I think, as I mentioned, shorter cycles, more volatility. The impact on returns. I've just been looking and beating my brain out. It looks like, look, if bond yields are going to be rising here because the government is scooping up all these excess savings, and inflation is going to be rising, and the world is more volatile, we need higher safe bond yields, and we need higher risk premium and lower multiples, because the world is going to be a lot more volatile, and macro volatility is hard to diversify away. So that doesn't look good for asset returns. As it turns out, as I'm going through all my numbers, it turns out not to make a difference. Rising bond yields, as I said originally, yes, your bond prices are going down initially, but then your income, your coupons start rising. And the same thing is likely to happen in equities. I find in the long run, higher inflation has no impact on equity returns. So, for example, here on the upper left is, on the vertical axis, the rolling 10-year return on US equities, the S&P, and on the horizontal axis is the level of inflation over those same 10 years. No correlation. There is a bit of a correlation in the lower left between changes in inflation over 10 years and the S&P return. With the more inflation goes up over a 10-year period from whatever level, it is bad for the S&P. But that is largely because of the oil crisis of the 70s. You take those things out, actually you don't find a correlation. We do find in the lower right This is against inflation average over 10 years and the multiple that you saw over the same 10 years. You do see higher inflation give you lower multiples, but you need to have more than 4% inflation. Otherwise, it doesn't really make that much of a difference. So overall, the impact on markets is going to be your asset allocation. I'm going to have to keep the same numbers in nominal terms for bonds and equities for the next 10 years. If you tell me, as I'm thinking, inflation more like 4% on average in the US rather than 2%, which is the consensus. The impact is going to be more what you do within markets. So yes, your current break even on 10s at the moment is 2.3. Yeah, I think your inflation linkers will do better on average over that period than your nominals. And, your floaters, so you're looking for assets that where there's not much of a price impact in the fixed income world because they're long duration or high duration, and more of an income impact as it links up with inflation. So your floaters, your short duration assets, high yield better than high grade. Our high grade index is about 3-year duration. Our high grade is about 8-year duration. In equities, we find a decent correlation. Healthcare and financials do significantly better at higher inflation. Industrials, consumer discretionary does not. Real estate, interestingly, has been a favorite of a lot of people to buy as an inflation hedge. Empirically, it doesn't actually work. And I think the core issue is there's a lot of different stuff in real estate. Some of these are very, if you buy a REIT, big industrial buildings, on commercial buildings, they easily have a 10-year fixed rental fee. You're buying a long duration bond. So in the real estate market, the core is, you would say, it's a real asset. It should go up in nominal terms as inflation is rising to maintain its real value. Well, the problem is the value of real estate and of other assets is really the present value of future earnings. Yes, your future earnings are going up, your rents are going up with inflation, but the world is more volatile now. And with interest rates rising, you're discounting that future income at a higher rate. So ultimately, there's not much change in the value of your real estate in a high inflation world. So commodities doesn't have as much that problem. So commodities have been a pretty good hedge. EM currencies also, because they're generally commodity exporters. One thing that is a horrible hedge is gold. Precious metals have been negatively correlating with inflation because they're affected more, I don't know exactly why, by interest rates. With low interest rates, the opportunity cost of holding gold is very low, and people have been piling into gold. So gold has not been a good commodity to hedge inflation. Your livestock, your agriculture, your industrial metals is much better. Energy, it's dependent on when. Basically, during the energy crisis, it was. But overall, energy is only a short-term one. So overall, last few points, I'm looking at my clock here to make sure I stay. Let me have another 5, 6, 7 minutes, hopefully. And I'll go relatively quickly on that so we can have a conversation with each other. So, in principle, your hedge funds should be doing well. I've been poo-pooing the hedge funds for a long time because they did not deliver. They charge a lot of money. They have not really been outperforming the markets. I'm going to be quickly moving further. I'm coming back to the intermediate slide on hedge funds here. Here is on the left side, the red line. Since last 20 years is a rolling 12-month return on the HFR hedge fund index, the so-called HFRI. Blue is a portfolio of bonds and equities with the same volatility over kind of a rolling 5-year. On the right side, The blue line is a difference between is hedge funds minus a matching portfolio of simple bonds and equities. Not a pretty picture. Yes, pre the financial crisis, hedge funds outperformed. Since then, on average, not. In the last year, hedge funds have redeemed themselves partly with a big return. The question is, will they make a lot of return in the future? So no, I am a bit dubious. You have to be careful what type of hedge fund. When we looked at this in the past, we find that hedge funds do very well when you move from a high volatility to a low volatility period, because all assets do well and they are leveraged. They were able to exploit the rally in risk assets. When you move towards higher volatility, hedge funds on average don't do as well. What the hedge funds that do well are the ones that are relatively market neutral. So be careful when you buy hedge funds, try to use the ones that have no beta, so to speak, that say they are market neutral, that have performed in a market neutral fashion, that don't have a beta to the overall risk markets. They should be the one that be outperforming them. So what do you do now? Are there certain assets that are better than that? Let me move back a little bit. I'm going to be now going very fast here in the interest of time. Are there certain countries better? Here is in the, I'm going to be arguing that the US is probably not the best place to put all your money. I've been doing this for the past 10 years and it'd be fantastic, but the upper left corner, that line, is a ratio of US equity total return cumulative divided by the rest of the world. As you can see, it's been up and down as you would expect it to be until the eve of about 2000. That was the NASDAQ peak. Then into the financial crisis, you had a US underperformance. And since then, 14 years in a row, the US has beaten the rest of the world. And it's now close to 60% of world capitalization in MSCI. So 14 years in a row. That's massive momentum, driven by the role of technology, corporate tax rate cuts, the dollar a bit stronger, and the rest of the world not performing from a profit point of view. Historically, we see decent mean reversion. The lower left corner gives you that 10-year rolling return as a scatter diagram on the horizontal, and the next 10 years on the vertical, always US minus the rest of the world. And as you see, after a decade of outperformance, it tends not to do well in the future. So decade tends to underperform. So that gives you a bit of a problem there. It's largely because of earnings growth. So there is an argument that the US will be underperforming. I think it will come from improvement in at least implementation of antitrust, increases in corporate tax rates, and a bit of a mean reversion in the dollar. So the odds are, as far as I'm concerned, that the US will be underperforming. Year to date, it hasn't happened yet. Year to date, we're talking about 16% in price terms for the S&P, while the MSCI World, which includes US, is 13%. So the US has still been outperforming year to date. So emerging markets, is that the place to go? Long story short, in the upper left corner, the same ratio, cumulative total return emerging divided by developed market. 7 years up since the 80s, then the 90s, EM crisis, 7 years down, then about 10 years up, and then about 10 years down. So clear momentum is still not good for emerging. There is in the lower left corner a very high correlation with the difference in EM potential growth minus the developed. When the long-term growth of emerging widens or rises relative to developed, EM equities tend to outperform. I go to my economist and say, productivity growth in EM is not good enough. Will probably now is not the time to invest in EM equities. They prefer the developed market. Tom, let me move here to China. What do you do with China? China is becoming a bigger and bigger part of the EM economy and of EM equity markets. So, to a large degree, China is, I keep telling people, is everything that emerging is not. The way it plans, the way it puts its top people on top, the way it executes a plan, the way it focuses on the supply side rather than the demand side. It's really long-term thinking is so unlike the rest of emerging, and in fact, the rest unlike the US also. So that should give you a lot more confidence about the performance of the Chinese economy. But when you buy stocks, you don't buy the economy. You buy a bunch of companies there. And what's been happening in China is, even since a recent regulatory clampdown, is that a lot of growth in China comes from new companies. This is the problem that we call, technically in equity markets, dilution. In that when you buy equities, you buy currently listed companies, and you would think with stronger growth, they will perform well. Well, it depends on where the growth is coming from. If the growth comes from new companies, small companies, family owned, that you don't own yet, then you, with your existing portfolio, don't really benefit from all that economic growth. And as a result, China has been long-term an underperformer of the listed stocks that you could buy over there, despite the fact that its economy has been doing so well. And I think will continue to be there. China is also currently clamping down on its largest companies. It pledges to improve or to undo a lot of the income and wealth inequality, to undo some of the power inequality. They've had a massive move in corporate concentration, and the Chinese government, the president, is basically does not measure his or their success by the performance of their equity market, unlike in the US, I have the impression, definitely under the previous government. So you have a government that is saying, well, in order for us as a party in a country to do well longer term, we have to improve consumer protection. We have to improve income inequality, the common prosperity they are talking about. So we have to reduce the power of these large corporates, these almost monopolies, with these natural monopolies that are there. All the things that I think the US should be doing, but isn't really doing it or can't do at the moment. I have respect for what China is trying to do, but that doesn't mean you're going to get rich by investing in that equity market. So I think that equity market is still not really the best place to be. You may want to make an exception for the new economy there. I'd say that the best assets to own in China is the currency and the bond market. The bond market now, it's been rallying from 3.5. We're at the moment at 2.9 there. I'd say that bond market's probably still going to be falling in yield. The currency, I think, over time will be rallying against the dollar. So in China, what you want to own is the currency and the bond market. The credit market, well, you see what's going on at the moment. The credit ratings were never informative. Stay away from the credit market. Right, a few more minutes quickly. One last point, and I'm going to let the rest be for questions, is equities and bonds by themselves won't give you a high return. If you move all into equities, you'll get a better return, but you do take significant risk. The issue is there any alternative there? One thing that we've identified is an asset class that sits in between the bond market and the equity market. It's what we call bond-like equity, equity-like bond. So these are your preferreds. These are your convertible bonds, your high yield, your real estate, your utilities, in Europe, the CoCos, the subordinated debt. All of that has an equity element and a credit element to it. What happens is, what have been observing, is that As a longer-term investor, you should actually not be too much worried about very short-term risk, noise, volatility. What you really care about is you put your money down, you invest it, and what you really are worried about is the risk, what happens to your portfolio in 5, 10, 15, 20 years, when you really want the money back. So your long-term risk. Now, if risk, as we all teach, is if the markets are efficient, they are random walks, there is no zero correlation in returns, then you can use short-dated risk, monthly vol, daily vol, quarterly vol, and through the square root of time, have an understanding what your longer-term risk is. If markets are subject to momentum, you're actually underestimating longer-term risk. If markets are subject to mean reversion, ups and downs, losses are offset by gains and vice versa. So your negative zero correlation means that shorter-term vol, that short-term noise, does not translate one for one into longer-term risk. We call that time diversification. So it is still there. In pure equities, the growth stocks, it's not that much there. If I can have you look at the table there a bit, there are two numbers in red on the top of that table. These are equities. Over this period, is 50 years, I think. Your 1 year vol is 17% on US equities, so since 1987. Your 10-year vol, so the standard deviation really on 10-year compound returns rolling, adjusted for a square root of time rule, is 18%, about the same thing, no time diversification. But if you look at the numbers highlighted in yellow for high yield utilities, real estate convertibles and hybrids, all these volatilities, these are volatility ratios, are much higher for the short term than for the long term. On average, your longer duration, your long-term volatility and risk is about half of what it would be if markets had no time diversification. So the conclusion from that is that the stuff in the middle between bonds and equities, your equity-like bonds, bond-like equities, have much lower long-term risk than pure equities themselves. So a portfolio that's focused on that middle does a lot better than the assets on in the reverse, basically your bonds or your equities themselves. So with that, let me, I promise not to be longer than my time allocation here. Carolina, if you can manage, the questions are coming in here.
Yeah, of course. Thanks a lot, Jan, for that very comprehensive overview. So I'd like to just kick it off with, I guess, the core of the presentation, which is the fact that you think that we're going to move into a more higher volatility regime characterized by higher inflation. And in that context, high quality government bonds don't look very attractive. But I just wanted to challenge that a bit and ask you, so to what extent do you think investors should completely disregard high quality government bonds in the context of a diversified portfolio, given traditionally their safe haven attributes and related to that risk mitigation properties? I think you mentioned on one slide that there's basically not much protection that they offer from your perspective in a diversified portfolio. How would you nuance that view, or is it really the case that it doesn't offer much downside protection here?
The protection I think you're talking about is a bit shorter term. So when people ask for protection, they ask for protection against what we call equity drawdowns. So you have your portfolio, long-term portfolio, which has the core really in risk assets. What you're worried about is that at some point on your way to this beautiful long-term future of risk markets performing relatively better, that you have a drawdown, a recession, a crash, and that it takes you long, just at a time when you actually need the money. So in order to give yourself a bit of shock absorbing against these crashes. You want an asset that performs well during those periods in a recession or in a crash. That used to be government debt. At the moment in Europe, the yields are extremely low. They're barely moving when equities are moving down or up. In the US, they're still doing a bit, but given the low yield, they can't do this job anymore. We've looked all over the place. Everybody's looked on the sell side to see whether we can find a better replacement. And the answer is simply, when we're honest, there isn't any. We've tried to find things. Some of them are a little bit better than others. Sometimes you think, let's buy into safe asset like Japanese yen in the past rallied on risk off, or the dollar. None of these do a lot anymore. Currency volatility is quite low also. There's a bit of hope that the Chinese bond market can do the job, because it's almost at 3% there. So it could rally a lot. But then you're assuming that in a US crash or a US recession, the Chinese central bank will then ease a lot to help the Americans. Not really. I don't think we can expect that. Its currency could be rallying, but it hasn't really. It's the dollar is still your risk-off element. So if you're then buying Chinese debt, it's probably going to be losing it on the currency. So I'm afraid there is no good solution. It is, some of us have recommended, well, if the volatility of your bond market is now down to 1/10 of what it was before, leverage it up 10 times. Okay, this is a bit of a point. You could do that in the US. So, but in Europe, leveraging up, I don't think is a good idea. So I'm afraid there is, aside from what I'm mentioning, for the long-term investor, buying those hybrid assets with good time diversification can help you. Private assets has been one of the preferred ways of large institutional investors to avoid the sharp drawdowns of the public equity markets. And for a long time, we thought, you know what, that's putting your head in the sand. The private equity market is not volatile because there's no market for it. You can't really get out. You're married to it. So it's fake low volatility. I'd say the institutional investor is turning around and saying, private equity is not fake. Public equity is fake. If we go back to the old argument of Bob Schiller, which says that the volatility of the public equity market is way too high relative to what a rational present value of future earnings ought to be. So we have this artificial machine algorithmic technical volatility of the equity market. In the private market, you avoid that casino behavior. So it's probably more private assets as a way of avoiding the drawdown from short-term volatility.
Very interesting, thanks. And then you also mentioned that so on the topic of high inflation risks ahead, and you also mentioned that there was this long-held view that the Phillips curve is dead. So are you challenging that notion, basically, that high inflation would come from rising wage pressure? And are we starting to see that now, maybe?
Well, we have a US, not a Europe, but a US, where there's been a lot of damage from this globalization in the last 20, 30 years. A very large part of society is hurting very badly. Life expectancy is down. Suicides, drugs, bad. These people are desperate and then have been voting for not exactly the best choices in politics. So I think the country and the government recognize it really needs to do something. The situation is much worse than in Europe. In Europe, people have been protected better against the onslaught of globalization. So as a result, you have now a government is saying, go for it, man. Now's the moment of having massive excess savings. We can borrow for free. We can borrow at negative rates. Go for it all. Really get wages up on it. And if we get a bit of inflation, then that's fine. Let it happen. We can always control it afterwards. So, and besides, maybe the Phillips curve is completely flat, in which case we can go for trillions and trillions on that. So it is basically an overheating, an on purpose overheating of the labor market and the overall economy in order to get people back to work and to give them proper wages on that. So it'll be a demand pull rather than a supply cost push. Very different from the 70s, more like the 60s, early 70s. We had under Johnson the Great Society fiscal easing. We had the massive cost of the Vietnam War, and we had a central bank that thought, nah, inflation is just temporary. So they kept interest rates very similar. So your late 60s, mid 60s into early 70s, pre the oil crisis, is what I think is going on at the moment. And that gives you a demand pull inflation, higher wages, which should be eating somewhat into profit margins, maybe not massively, which will give you that inflation. And everybody's going to, we're at the point where everybody's going to applaud it at this point. But it means higher volatility, and it means a shorter business cycle. We're going to get faster to overheating. We're about with capacity already at the US. Yeah, so that's, I think, for in my book, the most likely scenario. The debates is going on between those who think, one, it is all temporary, the Phillips curve is flat, you can't control inflation anymore, you're done. Those, and two, those who are saying the Fed will right on time normalize interest rates and prevent this inflation from happening. I am more the ones that are saying they're going to be taking their time. They're going to wait until inflation is out of control, and then they'll do something, cause a recession in about 3 years' time.
Mm-hmm. Okay. On that last point, I mean, to what extent, can policymakers allow rates to rise given the large debt stock and I guess, sensitivity to tightening in general?
Well, the question is sensitivity of whom and who are running policy for. If I think we have, in my mind, more of a government and likely a Federal Reserve is saying we don't run monetary policy for the S&P 500. We run it for the people, jobs. And if corporates are already making a ton of money, profit margins are all-time high at the moment. It's massive. If these people have to be paying a bit more, so be it. If the rich lose out a bit because their portfolio is no longer up or doubled from 2-3 years ago, so be it. We're focusing on wealth and income inequality. We're focusing on jobs for the middle class. That's more important here. So yeah, we can let inflation go up, and if that scares the equity market, big deal, big loss. It's a different priority, a different focus, I think, of the policymaker now.
Okay. So in that sense, just picking up from one question in the chat, probably the scenario where the US or the EU experience a lost decade of weak growth in sideways markets is probably unlikely, given those impulses that you've outlined.
I mean, so the likelihood that the US and Europe can do what?
We'll experience a lost decade of growth and sideways markets.
We don't have a lost decade of overall GDP growth. It's a bit on the weaker side, in particular in Europe. But what is bugging the current government and a lot of observers is not so much the overall GDP growth, but its distribution. So the average middle income wage earner in America has not seen any growth in real wages for 30 years. And you have a lot of people there hurting in manners that you cannot measure simply by the unemployment rate or wage rate. Health conditions are worsening. I mean, things are a bit similar to what they were in Russia about 20, 30 years ago. Longevity is falling. I mean, it's amazing. It's the only developed country where this is happening. The number of people dying from drug overdoses, suicides, health conditions, the health conditions of Americans is appallingly bad. So you have a government that is saying, in my mind, appropriately so, that we can't just look at the average. We have to look at the distribution. And if we're making things not as great for the rich anymore, where we can help those in the worst conditions, that is absolutely worth it.
Understood. There are a couple of questions about commodities, about how you would best allocate towards commodities. I think you said you like industrial metals. How do you see the outlook for copper in that context? So I know you had a slide up on copper. I don't know if you wanted to show that again, or just briefly kind of reiterate some comments about the commodities.
We have looked at the correlations of in commodities with inflation here. So you're seeing on the upper right corner gives you correlation on the vertical axis. On the horizontal is the holding period over which we measure the correlations. So you have if you see there at about 6 to 1 year, you have a high correlation of energy futures with delivered inflation in the US over those holding periods. The moment you're looking a bit further, 6, 8, 10, we're finding that your industrials start doing a bit better. Your precious metals are doing horrible there. So your energy is kind of a short-term thing. Your longer is more a combination of livestock, agriculture, and industrial metals, with precious metals doing poorly here, there. That is a correlation. Longer term, as you know, in metals, you have to be very careful about what metals are going to be most in demand as we decarbonize our economies. And there the idea was always copper, and that has been the right idea, although it's been the last 1 to 2 years that is really rocking and crazy. Some of the metals like palladium, I think, that are used in catalytic converters are not going to be doing so well overall. So I'd say your energy, I am wary. I am very wary about long-term, and I have to think 20 years almost, peak oil. We have a short-term issue with energy that because of ESG investing and climate investing, oil companies have been very constrained in investing in new capacity. So there is no new capacity of oil coming online. However, the growth of the renewable energy is very slow relative to the total energy demand of your economy. So your overall economy needs a certain amount of energy input, and the oil companies have been cutting back on capacity. So the supply of oil is falling faster than renewables can make up for it. So we're going to have a temporary, probably a number of years, of oil prices shooting on the upside before they're eventually going down again, really, really badly. So I'd say short, next 2 years, I'd be bullish on oil. 10 years out, no, I wouldn't want to oil it. Hold it, and I would stay with your industrials.
Understood. And with respect to gold, given the fact that real rates could stay negative over the coming decade, do you think that it makes sense to have an allocation? So here you're a bit negative on gold.
Well, gold is a tough one, because indeed, all in empirical studies have shown it correlates badly with inflation. It correlates well with interest rates, and depending on how you do it, it's best to do it with real bond yields or with nominal yields. Here, I see it's very, because the fall in nominal yields and real bond yields happen at the same time. So a study cannot really, empirical analysis cannot really separate whether it's nominal bond yields or real bond yields. So I'd say for me, for a longer run point of view, we're likely going to see higher both nominal and real bond yields. And I'm thinking 5, 10 years out rather than very short term. So this kind of correlation doesn't give me confidence that gold will be doing badly. That said, as an analyst, I think I understand kind of how to price financial assets. Gold is tough. Then gold has been, I mean, part of the correlation here is probably having to do with the zero bond yield world happened to be the world in which the central banks, because of massive QEing, became underweight gold, and in particular those at the other side of US sanctions have been massively buying gold here. So it may be a spurious correlation here. I cannot say as an economist that I understand clearly and find the negative correlation of gold to inflation rational. It may simply be a spurious correlation here. So if you want to have, I cannot convincingly tell you economically you should not be holding gold. So I can't. I don't do it personally. I rather do in the pure equity market. I'm still going to be doing better there. But I can't tell somebody in Switzerland you're completely wrong to hold it. I don't think you're going to get very rich on it, is my view. But it probably has some diversification value there.
That's interesting, thanks. And on the topic of hard to value financial assets, what is your view on crypto and how do you consider that in potential strategic asset allocation decisions?
I'm going to be betraying my age here. I'm not a crypto lover. I am a crypto denier, so to speak. My problem is that crypto, Bitcoin, distributed ledger technology, it's been interesting technology. But it's been used in an area where there was no need for anything. Currencies, the dollar, euro are performing fine. There is no inflation over there. QE has not created inflation there. So I didn't really see the need for cryptocurrencies. It is used in areas where people want to avoid privacy and avoid the law. So I think the regulators are going to be climbing down on it. That said, there is something to be said for using that technology to improve financial access, particularly in lower, at least in weaker economies, and to improve the efficiency of cross-currency transfers, which are still slow and expensive. Crypto is not doing anything faster. It's not really cheaper at all. So in my world, what would I add to my portfolio? And not crypto, nothing in that world, except I would have a decent allocation to the new finance, the fintech world. Having a diversified portfolio, really be careful that make sure you have a fully diversified one. That's where economic value is being created. Purely in crypto, I doubt there's a lot of economic value in that, and I'm wary of stuff that is high in price without it telling me where are the revenues coming from and how do I discount that. That's why I don't like anything in the crypto world, but I do like the fintech world.
Excellent, thanks. So back to revenue generating assets, a couple of questions on the bond allocation. What are your thoughts on emerging market bonds, particularly EM high yield bonds, very long duration bonds? Well, I guess given the inflation outlook, potentially negative, and perpetual bonds in portfolios.
Right, so in emerging, you have 3 fixed income assets. You have the currency, local bonds, and external debt. The external debt is your sovereign and your corporate, the old JP Morgan, MB and SEMBI indices. These are part of the dollar world. They give you a bit higher yield, not a lot, than what equivalent duration sector risk rating US or developed market debt gives you. But it is a bit more expensive to hold, meaning you pay higher fees. So overall, I think it belongs in a diversified bond portfolio. your local bond markets, so which is your, I don't have it on here anymore. Let me get my screen up here. So your local bond market, your emerging bond yield is now at 5.2%, while your developed government bond market is less than 1%. So you got pretty much about a 4.25% yield pickup from going from developed bonds to emerging bonds. So, and that's probably it belongs in a broad portfolio, but all the yield pickup comes from the currency. So your on average, your emerging, sorry, let me do this here. In the lower right corner is a carry, so the slope of the curve across our, in red, our global bond index, that is our developed index. The blue line is the average carry across a whole bunch of countries in our emerging markets. On average, it's the same thing. So if this is your developed curve, your emerging curve is simply parallel higher. The higher bond yield is the higher cash yield. So your effectively the yield you're picking up on emerging all comes from the currency. So you have to ask yourself, should EM currency be part of your portfolio? Longer run, it has done okay, but only until 10 years ago. The two charts on the left, the lower left corner of this slide is a total return on EM currencies coming from two different indices, and you see the big gains from the lows of the financial crisis all to the beginning of the last decade, and since then, nothing. So it's a bit wary at the moment, and this is in total return terms. So you are, it's a diversifier. At some point, it may be working again. If you think EM growth over time will be surprising on the upside versus developed, you should be in EM currencies largely, although the EM equity market will do that too. My advice is simply, you stick with only one of them, the Chinese renminbi. They have a plan. They execute their plan. It has good momentum. They want their currency to be competitive against the US dollar. I think your favorite within EM fixed income should really be Chinese government bonds and currency unhedged. That's what I prefer to hold.
Got it, thanks. So on your view on EM equities, I think you were less constructive given the longer term growth differential and limited productivity versus DM. Would you mind maybe digging a bit deeper into that? Because as one participant is saying, at least valuations seem quite interesting, and they are still expected to be the main driver of global growth going forward. Thanks.
Right. So the counter against not doing emerging are two. One, lower multiple. So as you say, cheap. Two, higher growth. Both of them are correct. First, on the lower multiple, and I haven't updated this chart here, in the upper right corner, three lines, a gray, blue, and red. Your blue is a trailing, your blue is the emerging trailing multiple, so price to earnings. Your brown gold is the same in developed. So your developed is almost always a higher multiple. The red line is a difference between those two. So that is your emerging minus developed multiple. Yes, your emerging is lower, hence it is cheap. But it's always cheap. The question is, what is the right level? And I'd say it's about average. It is not converging. And it seems to be pretty much around an average. That was a year ago. I suspect by now it may be a bit cheaper. But using the multiple to tell you when or whether to invest in emerging has been not a good trade. I mean, it never really worked. Second question is, Doesn't emerging have higher economic growth? Yes, absolutely. Issues, does it translate into higher earnings per share growth? In the lower left corner, 3 lines, your red line is the MSCI emerging divided by developed price index, red line going up, emerging outperformance, and vice versa. Your blue line is the ratio of your emerging to developed earnings per share. It's doing the same thing. But importantly, when I did this here, and it is no different to today, the data from MSCI starts in 95. Since 95, emerging earnings per share in dollars has fallen relative to developed, despite the fact that its economic growth in nominal terms was 7% higher. So economic growth, higher economic growth does not give you higher earnings per share growth, and primarily because of dilution. The factor I mentioned with China is that in the developed world dominated from the US, we've had no dilution. The growth is coming increasingly from the existing listed companies, not from the small caps and the new ones, all having to do with increase in business concentration, barrier to entry, economies of scale in the developed world, particularly in the US technology world. In emerging, your new growth comes from new companies that you do not own yet. Solution, by private equity emerging, don't buy the public equity markets there. I'm finding a decent correlation. We keep having debates among ourselves why, but the black line there, which is a difference on the horizontal axis between long-term economic growth emerging, called a potential, demographics, productivity, minus developed. So in the last decade, productivity growth emerging has come down faster than the developed world, and over that whole period, your equity market is underperforming. So I think basically you need a growth surprise in emerging. Growth surprises will do well for the equity market, but not the existence of higher growth, which gets diluted away by higher new equity issuance in emerging.
That's very interesting. Thanks. So consider PE and EM, I guess, is one solution. And in terms of, going back to fixed income, what is your view on perpetual bonds or very long-term bonds?
I'm sorry, my view on
perpetual bonds. Perpetual or very long duration.
Perpetual, sorry. But perpetuals are very, very, very long duration. By definition. So at these yields, absolutely don't hold them, don't touch. It is with the bond indices that I'm talking about, they are 6-7 year in duration over a 10-year holding period. At least they mature and you get new ones at a higher yield. With a perpetual, it is all price movements. Given your yield is what you're going to get, but you never really can catch up. At least with a 6-7 year duration, if you have higher inflation, after 10 years times is when your higher returns are going to be coming through, not with perpetuals. I don't see the point of perpetuals. Maybe for some immunizing pension plans that have nominal liabilities, it could make sense. But for a long only investor that doesn't have liabilities, yeah, not for me, thank you.
Makes sense, thanks. And then another question that we received is, so for a similar risk as a traditional 60-40 portfolio, how would you compose a portfolio for a longer term investor? And what could they expect for returns comparison?
I have here, basically, when I grab all my stuff and ideas together, I kind of say, here's what I like. So 2 concentric circles, an equity in blue, a credit and other stuff in green. There are no government bonds here. So I prefer really developed equity. I prefer healthcare, momentum broadly. I like high buybacks, still like value. and a bit of small caps. Climate is more diversified. China, just the new economy China. On the, I need a little bit of high grade. I do the US there. Some macro hedge funds, particular market neutral ones. Chinese bonds. I like the Chinese currency, and then basically the hybrids in the middle. Utilities, REITs, high yield, the whole fallen angel world, convertibles and preferred. So all the bases, all the kind of the stuff with higher long-term sharp ratios. What kind of returns can I expect in nominal terms on a portfolio like this? If you put in what I call a 20% fixed income, 30 hybrids, 50 equities, my guess would be close to just a bit shy of 4% in nominal terms in the US, and a bit more in Europe is going to be close to 3.